For the past 12 months, I've tested the 4 most popular broker platforms in the US: Webull, Charles Schwab, Vanguard, and Fidelity. But only one was truly worth it. And this wasn't some theoretical test where I read reviews or compared features on paper. I put real money on the line, made actual trades, held cash balances, dealt with their customer service highs and lows, and experienced firsthand what it's really like to be a customer at each of these brokerages. By the end of this video, you'll discover which platform truly deserves your trust, and which ones might be silently draining your wealth behind the scenes. This video is based on my personal experience and opinions. It's not financial advice or a recommendation to use any specific broker or platform. Always do your own research and consult with a licensed financial professional before making any investment decisions. Let's dive in. Most investors make a costly mistake, assuming that in today's world of commission-free trading, every broker is basically the same. I mean, if they all let you trade stocks and ETF for free, what could possibly be the difference, right? Wrong. Completely wrong. That belief isn't just naive, it can quietly cost you a fortune. The removal of trading commissions was one of the smartest marketing moves in modern finance. It gave investors the illusion of fairness while hiding the truth. These platforms still profit from you in ways that are invisible, subtle, and perfectly legal, slowly draining your returns without you even noticing. One of the brokers I tested, a name you definitely know and probably trust, is quietly draining money from its customers through hidden systems most people never even think to question. Another platform, despite its shiny reputation for innovation, turned out to be shockingly unsuitable for serious long-term investors. And one legacy institution, adored by a certain old-school investing crowd, was so frustratingly customer-unfriendly that I wouldn't recommend it to anyone, not even my worst enemy. This investigation goes deep. I'm talking about analyzing dense fee schedules that would put most people to sleep, digging through mandatory securities and exchange commission filings that these companies hope you'll never read, and tracking the actual real-world performance of my cash and investments across all 4 platforms. This isn't opinion or speculation. This is hard data from a year-long real-world test with my own money on the line. We're breaking this broker review into 3 key steps, each one focused on what truly impacts your bottom line. Step 1. We'll uncover the silent cash trap you don't see, exposing how each platform handles your idle money and whether it's quietly costing you returns. Step 2. We step into the trading battlefield, testing the tools, platforms, and execution speed that determine how efficiently your trades actually perform. Step 3. We explore the investment universe, what each broker truly offers, what's missing, and which one gives you the most flexibility to grow your portfolio. After that comes the support test, because when something goes wrong, the quality of their help can make or break your trust. And finally, we'll arrive at the ultimate verdict, revealing which broker truly deserves your confidence, your capital, and your long-term loyalty. By the end of this video, you'll have the clarity and confidence to know exactly which platform deserves your money. So, let's begin with what might be the most crucial, yet often completely overlooked, part of any brokerage account. Step 1. The cash trap you don't see. Here's something most investors never think about. What happens to your money when it's just sitting there? You know, the cash you deposited but haven't invested yet, or the proceeds from a stock you just sold, or maybe you're just building up cash for your next big purchase. That money doesn't just evaporate into the ether. Your broker does something with it, and the question is whether they're doing something good for you or something phenomenal for themselves. Every major brokerage has what's called a cash sweep program. Automatically, without you lifting a finger, your uninvested cash gets moved into some kind of interest-bearing account. The critical question is this: how much interest are you getting? And how much is your broker keeping for themselves? Let me tell you, this is where my research uncovered its first major shock, and it completely shattered the way I viewed one of America's most trusted financial institutions. Let's start with Vanguard. When your cash sits idle at Vanguard, it automatically sweeps into their federal money market fund. During my testing period, this fund was yielding approximately 5.28%. That's a genuinely competitive rate, closely tracking what you could get from a high-yield savings account. Vanguard is essentially passing through the full market rate to you, the customer. That's exactly what you want to see. Over at Fidelity, my experience was almost identical. Any uninvested cash in my account was automatically swept into their government money market fund, which during my test period was yielding about 4.97%. That's a solid, fair rate, right in line with the market. Fidelity isn't trying to nickel and dime you on your idle cash. They actually treat your money with a level of respect that's becoming rare in this industry, paying you close to what your cash is genuinely worth in today's rate environment. Then for Charles Schwab, honestly, this is where things took a turn. At Schwab, our idle cash doesn't go into a money market fund by default. Instead, it's automatically swept into what they call their bank sweep program. And the rate you earn? Around 0.45%. While Vanguard was paying about 5.28% and Fidelity around 4.97%, Schwab was paying less than 0.5%. It's frustrating because Schwab positions itself as a trusted investor-first brand. But under the surface, this setup quietly funnels your idle cash into their own bank, where they pocket the spread, the difference between what they earn and what they pay you. And that, to me, felt like I was cheated. This isn't some small discrepancy or rounding error. This is a deliberate, calculated business decision. Schwab has chosen to systematically underpay their customers on cash balances, pocketing the enormous difference for themselves. Schwab will tell you that you can opt out of the bank sweep and manually move your cash into one of their money market funds, and to be fair, those do pay competitive rates. But here's the catch. That's not the default option. By default, every new customer who doesn't know any better gets funneled straight into the 0.45% bank sweep. It's the path of least resistance, the one designed for you, not by you, and it quietly works in Schwab's favor, not yours. This is what I call a sophisticated customer tax. If you're savvy enough to know about this issue, do the research, and manually change your settings, you can avoid it. But Schwab is banking, quite literally, on the fact that most customers won't. They profit enormously from customer inertia and ignorance. According to their own the Securities and Exchange Commission filings, this bank sweep program generates billions in revenue for Schwab annually. It's not a side business, it's a core profit center built on the backs of unsuspecting customers. But the cash story doesn't end there. I also looked at what happens when you want to borrow money through margin lending, or when you want to leave the platform entirely, and the patterns here are revealing. Fidelity's margin interest rates are consistently lower than Schwab's, sometimes by a full percentage point, or more, depending on your balance. That means if you ever need to borrow against your portfolio, it costs you meaningfully less at Fidelity. Every broker makes money on margin, but Fidelity's rates are more competitive and customer-friendly. And then there's the exit fee situation. Something I find honestly hard to justify. If you decide to transfer your investments to another brokerage, Fidelity charges you exactly nothing. $0. They respect your right to take your business elsewhere without penalty. Charles Schwab, on the other hand, hits you with a $50 outbound transfer fee. And Vanguard, they charge a shocking $100 to transfer your assets out. It feels less like a service charge and more like a punishment for daring to leave. A final middle finger on your way out the door. Now let's talk about Webull, the newcomer in this fight. Webull stands out because it's trying to challenge the big players with a completely different approach. They're mobile first, targeting younger investors with a sleek app and a gamified trading experience. During my testing, Webull's interest on idle cash program offered around 4.5% annual percentage yield. Pretty competitive. It's definitely miles better than Schwab's bank sweep, though still a bit behind Vanguard's money market rate. In my testing of Webull, I discovered that while the platform is a Securities Investor Protection Corporation member covering securities and some cash if the broker fails, the uninvested cash is swept into partner banks for Federal Deposit Insurance Corporation, assuming everything is processed correctly. That means the protection may depend on the exact sweep mechanic. So when I say it feels less straightforward than your cash is insured like a bank savings account, that's why. The verdict for step 1 is crystal clear in my mind. Vanguard and Fidelity treat your uninvested cash with genuine respect, paying you fair market rates that reflect what your money is actually worth. Webull is competitive but raises some security concerns with how that cash is held. And Charles Schwab? Schwab's bank sweep is an absolute disappointment, a massive self-inflicted wound that completely undermines their carefully cultivated image as a low-cost, customer-first leader. It's such a glaring issue that, for many investors, it should be a deal-breaker, a clear signal that it's time to reevaluate where you keep your investments. This is the moment that reveals whether your broker is working for you or quietly working against you. Step 2, the trading arena. Let's move on to what most people think of when they hear brokerage platform, the actual experience of buying and selling investments. This is about the quality of the tools at your fingertips, the power and sophistication of the platform, and critically, what's happening behind the scenes when you hit that buy or sell button. I'm going to be honest with you, I went into this test with certain assumptions about who would win this category, and I was partially right, but also surprised in several ways. Let's begin at the very top tier of trading platform tech, Thinkorswim. For the unfamiliar, Thinkorswim was the high-end, pro-grade platform developed by TD Ameritrade and later acquired by Schwab when they bought TD Ameritrade. What really stands out is how built for serious traders it is. If you're executing multi-leg option strategies, trading futures, layering dozens of technical indicators, or building automated scripts, this platform is right at the summit. I'm not exaggerating when I say, in my view, it's the single best retail trading platform in the US and possibly the world. The platform is extraordinarily powerful. It offers real-time data, customizable charting that would make a professional technical analyst weep with joy, and features like the on-demand function that allows you to rewind the market and practice trading against historical data. If you're serious about day trading, swing trading, or running sophisticated option strategies, Thinkorswim is not just good, it's essential. It's leagues ahead of anything else available to retail investors. For the people who live and breathe the markets, Thinkorswim is not just a reason to be at Schwab, it's the reason, possibly the only reason that justifies tolerating Schwab's other significant flaws. If you are a professional level trader, stop reading now. Go to Schwab, get Thinkorswim. Just make sure you manually switch your cash sweep to a money market fund. But here's the reality check. Most investors are not professional level traders. Most of us are regular people building wealth for retirement, saving for our kids' education, or trying to grow our net worth steadily over time. We don't need or want the overwhelming complexity of a professional trading terminal. We need something powerful enough to make informed decisions but intuitive enough to use without a manual and a YouTube tutorial series. For that vast majority of investors, Fidelity absolutely shines. Their web-based platform is, in my testing, the best all-around trading experience you can get. It strikes that perfect balance, clean and intuitive enough for a beginner to navigate, but sophisticated and powerful enough to satisfy experienced investors. Here's where it gets pretty interesting. When I dove into the Fidelity platform, I found that the tools were truly impressive. I could pull up advanced charts with dozens of indicators, drag trend lines, compare stocks to indexes going back decades, and save layouts across devices. On the research side, I tapped into fundamental data, third-party analyst reports, yes, including firms like Morningstar, and timely news and earnings info, all within a workflow that felt naturally designed for me, not an afterthought. It felt professional without being overwhelmingly complex. And then we have Vanguard, and frankly, this is where things got uncomfortable for me. Vanguard's trading interface feels dated. When I logged into Vanguard, it quickly became obvious. It's built for long-term investors, not day traders. The design feels more medieval than modern. If your aim is advanced tools or live chatting, forget it. You won't get such at Vanguard. The interface is clunky, the navigation feels like it belongs in 2005, and research integration? Barely there. If you're trading with speed or sophistication in mind, you'll feel the limitations immediately. Here's something critical to understand. I believe Vanguard's setup is intentional, not just an outdated platform or tech neglect. Vanguard has built a business model around long-term, passive buy and hold investing. They've always viewed it as counterproductive for most investors. So when I used the platform and saw minimal advanced trading tools, cumbersome workflows, and fewer incentives to trade quickly, I didn't chalk that up to they're just behind. I saw it as a reflective choice of the firm's core values. Their interface doesn't scream trade fast and often. Instead, it screams pick your funds, set it, and step away. If you're activating multi-leg options, swinging trades, or pushing for market timing, this isn't built for you. If you're aligned with buy and hold, it makes sense. But that mismatch between your style and their philosophy can feel like the platform is working against you. Now let's talk about Webull. This is where things get really interesting. Webull's trading platform stood out to me from the moment I opened it. I'm talking slick, modern, and mobile first. Everything moves smoothly, the visuals are clean and contemporary, and it clearly feels built for a generation that expects intuitive, app-like design. For younger investors, or anyone who prefers a user-friendly interface over legacy complexity, I found it to be one of the most visually appealing platforms I've used. That said, style isn't everything. There are trade-offs, which I'll cover in a bit. Webull offers real-time market data for free, which is something that traditional brokers often charge for or provide on a delayed basis. They have excellent charting tools built right into the app, with dozens of technical indicators, drawing tools, and customization options. For someone who wants to do technical analysis on their phone, Webull is genuinely impressive. But, and this is a big but, Webull's platform also has a gaming vibe that made me uneasy. Its design is slick, colorful, and mobile first, and it clearly feels built to engage. There are community features, leaderboards, social feeds, and reward systems that seem to encourage you to participate, share, compare, and trade. To me, that raises signals. Trading should be deliberate, not a quest for badges or popularity contests. When your platform nudges you to follow what's trending or shows you how you rank against others, it begins to feel less like investing and more like social gaming. That's not necessarily a deal breaker. But if you're someone focused on long-term strategies and avoiding impulse trades, this gamified vibe is something you should be aware of. This isn't necessarily a bad thing if you're aware of it and have strong discipline. But during my testing, I caught myself placing trades on Webull that I probably wouldn't have made on Fidelity or Schwab, simply because the process felt so smooth and instantly gratifying. The platform is intentionally built to boost engagement, which is just a fancy corporate way of saying they want you to trade more often. That might be great for Webull's bottom line through payment for order flow, which I'll explain shortly, but it's rarely good for your long-term results. Here's another area where Webull falls short, at least in my experience, is research and education. Sure, they provide news updates and some basic data, but it doesn't come close to the depth or quality you get on Fidelity. If you're someone who likes to dig deep before making an investment, Webull's research tools will probably leave you wanting more. Let me address something that none of these brokers do particularly well: tracking your actual investment performance accurately. You'd think this would be basic functionality, but every platform's built-in performance tracking has significant blind spots. They often ignore dividend reinvestments, can't properly handle currency conversions on international holdings, fail to account for transfers and deposits correctly, and become completely pointless when tax season rolls around. This frustrated me so much during my testing that I ended up turning to a third-party portfolio tracker just to get a complete picture of my investments. It automatically pulled in all my trades from each broker, tracked dividends accurately, handled currency conversions, and even gave me clear diversification and tax reports, basically everything I wish these platforms offered natively. Honestly, if you care about understanding your true performance, using a dedicated portfolio tracker is one of the best moves you can make. Now we need to talk about what happens behind the scenes when you place a trade, because this is where things get murky and controversial. There's a practice in the brokerage industry called payment for order flow that most customers don't understand, but that profoundly affects whose interests are really being served when you trade. Here's how it works. When you place an order to buy or sell a stock, your broker has choices about how to execute that order. They can send it directly to a public exchange like the New York Stock Exchange or NASDAQ. Or they can sell that order to a massive market-making firm like Citadel Securities or Virtu Financial. These market makers pay brokers for the right to execute your order, hence payment for order flow. Now, the market makers claim they're providing a service called price improvement, meaning they're executing your trade at a slightly better price than you would have gotten on a public exchange. And sometimes that's true, but there's an inherent conflict of interest. Your broker is being paid by a third party to route your order a certain way. The question becomes, Are they really getting you the absolute best execution, or are they getting themselves the best payment? Both Schwab and Webull receive payment for order flow. This means they earn money when they route your trades to market makers who pay for that flow. At Schwab, the filings reveal that they receive fixed rates per share or per option contract from market makers. At Webull, it's even more significant. In 2024, more than half of their total revenue came from payment for order flow. In other words, monetizing your trades is not a side business. It's a central part of their business model. Fidelity, on the other hand, made a deliberate choice that truly sets them apart. They don't accept payment for order flow on stock or ETF trades. Their order routing system is built entirely around one goal: getting you the best possible execution price every single time. There's no hidden incentive or third-party kickback influencing where your trades go. Vanguard follows the same principle, refusing payment for order flow and staying true to their long-standing, client-first philosophy that prioritizes investor outcomes over profits. Now, to be fair, the Securities and Exchange Commission requires all brokers to disclose execution quality statistics, and studies have shown that even brokers accepting payment order flow generally do provide decent execution. You're probably not being dramatically ripped off on any individual trade, but the question is one of structural alignment. Do you want your broker's routing decisions influenced by payments from third parties, even subtly? Or do you want their only incentive to be getting you the best price? For me, the answer is clear. I want structural alignment with my interests, not a business model built on selling my orders to the highest bidder. If you're a professional level active trader who needs the absolute best tools available, Charles Schwab's Thinkorswim platform is unmatched. It justifies being at Schwab despite the cash sweep disaster, though you need to manually fix that setting immediately. For everyone else, the vast majority of investors, Fidelity delivers the best overall trading experience. Their web platform is powerful, intuitive, and backed by excellent research. Their order routing is structurally aligned with your interests. They strike the perfect balance for serious but not professional investors. Vanguard's platform is fine if you're a true passive investor who rarely trades, but it's genuinely frustrating for anyone else. Webull has a beautiful interface and impressive free features, but the gamification and heavy reliance on payment for order flow raise a big concern for me. It's fun to use, maybe too fun, and that's precisely the problem. Investing shouldn't feel like Candy Crush. It should feel like the serious financial endeavor it is. Now, this is the part you absolutely need to know about these brokers, the details that can make or break your portfolio. Pay close attention, because what I'm about to show you could change the way you think about where your money belongs. Step 3. The product universe. What can you actually invest in on these platforms? In today's complex investment landscape, product flexibility is not just nice to have, it's essential. The differences I discovered here reveal fundamental philosophical divides between these brokers. Let's start with the basics. All 4 platforms allow you to trade stocks, ETF, mutual funds, options, and bonds. If you're investing in standard US equities and funds, you're covered everywhere. But the divergence becomes stark when we look at 3 key areas: fractional shares, international investing, and cryptocurrency. Fidelity is the undisputed champion here. They offer fractional shares for over 7,000 stocks and ETF, basically covering anything you'd reasonably want to invest in. During my testing, I used this feature constantly, building positions gradually in expensive stocks, investing exact dollar amounts regardless of share price, and generally having complete flexibility in portfolio construction. Webull also offers fractional shares for a decent selection of stocks, though their list is smaller than Fidelity's. It's a solid offering that works well for most investors, but there are some gaps if you're looking for more obscure securities. Charles Schwab's fractional share program is bizarrely limited. They only offer it for S&P 500 stocks. Why? I have no idea. It seems like an arbitrary restriction that unnecessarily limits your options. If you want to invest in a smaller cap growth stock with fractional shares, you simply can't at Schwab. And then there's Vanguard, which only offers fractional shares for its own ETF. That's it. If you want to buy fractional shares of anything else, you're out of luck. For a platform trying to serve the mass market of everyday investors, this is a glaring omission that feels increasingly outdated in this new age. Now we get to a part most investors overlook, but that can make or break your experience: customer support. This is where you see the broker's true colors, how they handle problems, answer questions, and actually treat you when things go wrong. Pay close attention, because this could completely change which platform you trust with your money. When your financial future is on the line, when something goes wrong with your account, or when you just have a complicated question that needs a real human being to answer, the quality of customer service becomes absolutely paramount. This round produced perhaps the most dramatic variation in quality I experienced during the entire year of testing. Let's start with the benchmark for excellence: Fidelity. Honestly, their customer service blew me away. It's the best I've ever seen in the financial world. They offer 24/7 phone support and live chat with US-based reps. I'm talking real people, not outsourced call centers, who actually understand US tax rules, regulations, and investment products, and can walk you through them clearly. I tested their support multiple times throughout the year at various hours, including late at night and on weekends. Wait times were consistently short, usually under 5 minutes even during market hours. The representatives were not just polite, they were genuinely knowledgeable and empowered to solve problems on the first call without endless escalations and callbacks. I had one particularly complex situation involving a backdoor Roth IRA conversion, which, if you know anything about, involves specific timing and reporting requirements to avoid tax penalties. I called Fidelity at 9 p.m. on a Wednesday, and within 20 minutes, I was speaking with a specialist who walked me through the entire process step by step. sent me follow-up documentation by email, and even called me back 2 days later to make sure everything had been processed correctly. That's not just good service. That's premium concierge-level service that you would normally expect to pay for, offered completely free to every Fidelity customer. Regardless of account size, it's genuinely remarkable. Charles Schwab also offers comprehensive support, including phone, chat, and an extensive network of physical branches for in-person help. Historically, Schwab's service was considered excellent, competitive with Fidelity. However, since the massive TD Ameritrade merger, their service quality has noticeably degraded. Moreover, many former TD Ameritrade customers are deeply unhappy with the forced migration. The TD Ameritrade website and apps, which had their own loyal following, have been shut down, with everyone pushed onto Schwab's platform. Features that TD Ameritrade customers loved have disappeared, and the transition has been rocky, generating a massive influx of support calls from frustrated customers trying to figure out where everything went. I'm not saying Schwab's support is bad, it's still decent compared to many industries. But it's clearly stressed, and the merger has created friction that impacts the customer experience. Webull's customer service offering is where my concerns really started to rise. As a relatively new, tech-focused broker, Webull largely relies on email and in-app messaging. Yes, they have phone support listed, but when I tested it, I faced slow response times and unclear resolution paths. It's one thing when a trade goes through smoothly. It's another when something goes wrong and you need real-time help. If you're holding large positions or need help when things break, this is a serious point to consider. Webull email responses typically took 12 to 24 hours, occasionally longer. That's fine for general questions, but problematic if you have a time-sensitive issue. The responses I received were often generic and template-like, suggesting that I was communicating with Tier 1 support staff reading from a script rather than experienced financial professionals. I had one situation where a dividend payment appeared to be credited incorrectly to my account. I submitted a support ticket, received a generic response asking me to provide more information, sent that information, waited another day, and eventually got a response that essentially said, "It looks correct to us," without actually addressing the specific discrepancy I had highlighted. I ended up just accepting it because the amount was small, but the experience left me deeply uncomfortable. What would happen if I had a serious problem involving thousands of dollars? For a broker that's essentially operating with a skeleton support staff to keep costs low and maintain commission-free trading, this is the inevitable trade-off. You're sacrificing service quality for low fees. Whether that's worth it depends on how confident you are that you'll never need help. And then Vanguard. Honestly, friends, their customer service is so frustrating it almost feels like a joke. Out of all the major financial institutions I've dealt with, and that includes credit card companies and health insurers, Vanguard's support ranks at the very bottom. With Vanguard, here's a key piece of the support puzzle. Their live support lines are open only Monday through Friday, 8 a.m. to 8 p.m. Eastern Time. So if you run into a problem after 9 p.m. or on a Saturday, you're basically waiting until Monday morning for help. For many investors, that gap in service is a serious concern. There is no branch network. Everything is phone or mail, and phone hold times are absolutely atrocious. I timed every support call I made to Vanguard throughout the year, and the average hold time was 47 minutes. Yes, 47 minutes. My longest hold was 1 hour and 23 minutes just to speak to a human being about a relatively simple question regarding a required minimum distribution. In my experience, Vanguard's support is frustrating in more than just availability, it's about depth. When you finally get someone on the phone, they're polite enough, but often seem overwhelmed and undertrained. I found that routine queries are handled fine, but anything a bit complex triggers escalations, long holds, or callbacks days later. For investors who need responsive, skilled help, that gap can feel like a real problem. Vanguard's customer service philosophy seems to be built around the assumption that if their fees are low enough, customers will tolerate being treated poorly. It's a low-cost, digital-first model that has come at the direct and total expense of the human support element. You are not a valued client. You are a case number, an annoyance, a cost center to be minimized. After a full year of testing all the major brokers with my own money, 2 platforms really stood out for me, Fidelity and Webull. Fidelity impressed me not because it's perfect, but because it simply worked. Smoothly, consistently, and without the deal-breaking issues I found elsewhere. Their cash management felt fair, with a competitive 4.97% money market sweep yield. The platform struck the perfect balance between intuitive and powerful, and trade execution was clean, no hidden conflicts from payment for order flow. Then there's Webull, which genuinely surprised me. It's sleek, modern, and incredibly fast. The app experience was smooth. The visuals were top tier, and for anyone who enjoys active trading or monitoring their portfolio on the go, Webull nailed that experience. While it's more geared toward active traders than long-term investors, it's easily one of the best mobile-first brokers out there today. Throughout my testing, I found myself naturally using Fidelity for research, trading, and holding cash. And Webull when I wanted a fast, engaging trading experience. No hidden fees, no unnecessary restrictions, just platforms that worked reliably for what I needed. This is purely my personal experience. I am not recommending Fidelity, nor am I partnered with them. Always do your own research and consult a licensed professional before making any investment decisions. If this video gave you value, I'm glad. And if your goal is to build a powerhouse dividend portfolio, don't miss the video above. It's packed with everything you need to build a successful dividend portfolio. I will see you there.